Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined today by Miranda Seath, Director of Market Insight and Fund Sectors at the Investment Association. Thank you for joining me today, Miranda.
I'm really delighted to be speaking with you, Kimberley.
So could you give us a bit of a background into yourself and how you got started in the industry?
Well, it's interesting because I was looking at the people that you've interviewed in conversation with, and one of them is Natalie Holt. So, and I used to actually work for Platform, which is part of the same group as Money Marketing. So I remember when starting out when Natalie was editing Money Marketing. So it's a real pleasure actually to be able to be speaking with you. I know everything has changed, but that was part of my introduction to the industry, and my background has really long been in research, but I started out looking at investment distribution and thinking about investment platforms, but with a particular emphasis on platforms that financial advisors use, and looking at the financial advice market as well as discretionary wealth management. So, and I started in Platform, I'd say it feels like a long time ago now, but then I kind of moved through the industry. I joined Next Wealth for a short time and then came to the Investment Association about 5 years ago now, and my remit is fairly broad. I still do a lot in the retail market, and is very, very close to my heart. I think it's a hugely interesting and important market for investment managers. But the scope of what I do could be anything from our institutional data and analysing that right through to investor research and looking at what investors are thinking. And we also do a lot of analysis on retail fund flows as well.
So that's a lot of broad experience. So I think you're best set for a lot of the questions I have here today. So starting off with strategic insights for UK savers. I saw that the IA has been advocating for inclusive strategy for UK savers. So I want to know why that is and what are the core objectives behind this initiative.
So I think one of the things that we do a lot of, as I said, is investor research. And what we find when we look at the national population, a national sample of UK adults, is that although about 23% hold the stocks and shares ISA, the proportion of adults invested in cash savings is much, much higher. It's about 75%. And so our campaign is really to try to kind of drive more of those cash savers into investing so that we can really start to see in the next 10 years the level of people holding some kind of investment product match that kind of percentage for cash savings. And that is partly because if you look at the data and you look at what would happen if you invested, let's say, £10,000 in a cash savings account versus an investment account over 10 years, and you pick a kind of standard fund, the return that you're going to get on investing is much higher. So I think when we look at it, if you look at a global equity fund, it's something like you would end up over 10 years. If you put 10,000 in, you'd be looking at about 18,000. But if you put that into a cash savings account, accounting for the impact of inflation, your money would actually be worth less than the 10,000 because, obviously cash doesn't necessarily stay static. So that inflationary impact is significant. And I think a lot of the UK population don't realise that. They think cash is safe, they think it's stable, And obviously now interest rates are higher. People are thinking, well, I can get a decent return on my cash, but there's still that inflationary impact. And what they're losing out is that the magic of compounding. So that kind of compounding effect of investing, where you're kind of adding, the kind of that turbocharges your investment return. So yes, markets can be volatile. Yes, sometimes returns go up and down, but over the long term, over at least 5 years and preferably 10 years, you're always going to do better putting your money in an investment.
Yeah. I think I heard from someone the other day, them saying that Einstein apparently said that compounding is like the eighth wonder of the world. Not sure if it's actually attributed to him, but there you go. I think it is very important. But obviously, there are a lot of barriers for entry for people. You've been talking about whether it's awareness, or for me, I think it might also have to do with marketing and tech products that are marketed to different demographics. Because I remember when I was in my 20s, I use my phone a lot. I see a lot of adverts for apps. I saw Moneybox, and that's when I got first introduced into stocks and shares ISAs. And then that's when I first started using it, because it was also made so easy for me. Whereas if I think of someone from like my mother and my father's generation, they're just not as tapped into that. So do you think that is one of the barriers for entry for some people? And how can those barriers be addressed?
Yeah. Well, first of all, Kimberley, I can't believe you're not still in your 20s. So just looking at you, look very young.
Thank you. Thank you.
But yeah, I think there are barriers, and I think those have changed over time. And clearly, one of the key things that we need to look at is how do we remove those barriers to allow people to understand the benefits of investing, and crucially make it easy for them to do so if they want to do so. I think for this generation, clearly technology and ease of access is very, very important. And when they do start investing, the way that they are engaging with their investment account is through apps. And actually, when we looked at our own data, that's for anyone under the age of 45. The app is the kind of preferred first way of engaging with your investments once you've started investing. And I can relate, because time is finite. Like on the train into work, it's a moment where I can kind of think, oh, do I want to go in and have a look? Might I want to kind of buy or sell? I'm not doing that all the time, but it is so accessible, particularly when we're on the go a lot. I think one of the challenges we've seen in the UK is that although there are lots of things that have been good about the introduction of the retail distribution review and advice, and the advice market professionalising and becoming fee-based, what it has meant is that we don't have bank distribution in the same way that they do on the continent. So that kind of ability to cross-sell investment products through banks to kind of, although banks do have investment arms, we kind of lost a bit of a momentum there. And we've started to see other different types of apps come out that have started to capture the imagination. So it was interesting, you've got, you mentioned Moneybox, you mentioned, as a great way in. The brilliance of apps like Moneybox is that you can actually, it's accessible, but it's also about investing little and often. And I think that's really important. And a lot of people, when we talk to them about investing, so one barrier is your ability to access it easily. The other barrier is the feeling that a lot of people have is that they need a lump sum. They need at least £5,000 to £10,000 to start investing. And they don't have that, particularly if they're young. They can maybe put aside about £50, £100 a month. And that's where I think we do need to kind of work harder, which is where you see products like Moneybox come out, AJ Bell do Doddle, for example. And I think the industry is starting to recognise that. It's like, let's make it accessible, let's make it technologically easy, and let's allow people to put money aside little and often. But the difficulty can be is that, a brand like Moneybox is having to compete with big banks. How do that marketing spend to get customers in can be really challenging. And I think that is difficult. It's how do you reach people? I do think the pandemic has been an interesting dimension, because what we've seen in our data is more people coming into investing. So and some of that is to do with social media becoming more visible, stuff happening in the market that's interesting, things like meme stocks. And you can feel a bit uneasy about that and think, oh, is it like gambling? But what it has done is brought investing into people's consciousness. And the thing that we need to do now is keep them engaged, keep that momentum, but drive them into good behaviours. So long-term investing, thinking about a diversified portfolio, how can we do that too? So I guess to kind of wrap it up, I think we need to do better on engagement and making it easier to get people in. I think we need to do more about helping younger people save little and often. And I think it's about then encouraging the right behaviours. So this kind of grey area of guidance. I think it's going to be a big moment this year, the advice guidance boundary. How can we do more to then drive the right behaviours for the types of people who are not going to be able to, you don't have enough money to afford advice, and maybe don't have enough complex needs to do it. I think we need to do better to serve that cohort.
Yeah, definitely. And talking about our audience of financial advisors, they often serve as a bridge between savers and financial solutions because they have more knowledge in that aspect. But what role do they play in delivering the inclusive strategy that you're talking about?
I think advisors have an absolutely huge role to play, because what we know is that once people get advice, they tend to make better choices. So I remember actually when I was working at platforms, so this is pre the Investment Association, but in 2016, partly as a result of the Brexit referendum, you saw a lot of property funds having to suspend, and there was kind of I think it's fair to say turmoil in the property funds market. And actually, advisors were able to tell their clients to advise their clients on the right behaviours around that, which is often not to kind of have a knee-jerk reaction to sell out. And I think you saw that again in 2018. And when you see markets being particularly volatile, as we've seen recently, advisors are able to kind of help their clients think longer term and to help them manage through those difficult times where even, the most seasoned investor, when you see, the value of some of your equity funds start to plummet, as we have seen in recent years, there was a little part of you which is thinking, God, this is rough. I mean, over like 5 to 10 years, these things all work through the system, and ultimately, you will still do pretty well in an equity fund. But this is the kind of, I think, these moments, and we've had one recently with the budget as well. And I think, for example, one of the things that we know has happened, which is not a great outcome, particularly the direct platforms have said people were taking their pension tax-free lump sums in the run-up to the budget, because there was so much speculation about what the Chancellor would do. Now, that's a very poor outcome. But advisors are able to kind of help clients manage these difficult moments and think long-term about their investments. And we're all of us, I think it's fair to say most of us, we're not just investing because we love the thrill of seeing the S&P 500 go up. No. We're investing because we want to buy a house, or we want to put our kids through, into school, or we want to, help plan a better retirement. And that's, I think, an absolutely critical part of what advisors are doing, is helping people realize their financial dreams, their financial goals. How can they be comfortable? How can they put money aside for their children, and that is about investing. But it's not just about that. It's about all of the other dynamics that come with that, which is tax, which is thinking about gifting for your children. So I think they're an absolutely critical part of inclusive investing. The only challenge is that it is only going to be economically viable for a certain part of the population to take advice, because ultimately you do need to have a certain level of investable assets. And I think for me that this year it's going to be pivotal, looking at what we will see with the advice guidance boundary review, which is how can we better serve that mass market who sits underneath, who either, not at the right stage. I mean, if you don't have complicated affairs, you may not need ongoing advice, or they might not have the right level of wealth. I think most of us at some point in our lives will need advice, particularly as we get older and we start to have more complex plans. We're thinking about retirement, but it's how can we serve different parts of the market? Some of that is absolutely through advice, but we have to look at other solutions as well, I think, to kind of bring more people in to inclusive investing, giving them access to whether it's advice, whether it's guidance, different ways of making sure that they have better outcomes.
Yeah, definitely. And you did mention the budget earlier. So I wanted to reflect a bit more on last year and how investors responded to major events like the budget, as well as the US election. Could you give us a bit of insight into that?
Yeah, so one of the things, as I said, that we look at on a monthly basis is what's happening in the retail funds market. So what we're really looking at is UK investors, and a lot of this is driven by decisions made by financial advisors or wealth managers, I should say, on behalf of investors. Some of this will be direct investors, people who are investing through investment platforms or directly with fund managers as well. But what we were seeing in the budget, so 2024 has been a year where we've started to see more money coming into investment after investment funds, after a very, very tough 2022 and 2023 where we saw big outflows. So investors have cautiously been building back, particularly as we saw a better outlook, I would say, for the interest rate cycle, inflation coming under control. We've seen the Bank of England cut interest rates. But in the run up to the budget, so in September and October, we saw significant outflows. So across those 2 months, outflows of about 9.5 billion, just under 9.5 billion, which is a shift back to the difficult times, the difficult monthly figures that we were seeing in previous years. And I think a lot of that is to do with anticipated tax changes. Our sense, and I think this is kind of borne out by talking to people in the industry, is a lot of this is fairly wealthy people who have assets that are not wrapped, realizing their capital gains before capital gains tax was raised, because a lot of it was coming out of equity. So there's higher gain, higher return type asset class. And I think what backs that up is that on November data, so the month after the budget, we saw a 1.6 billion inflow. So it is tax. People do manage their investments with one eye on how that will also impact the level of tax that they pay. I think our fear potentially was one of the challenges, I think, with the budget was people not knowing what would happen and trying to kind of anticipate what would. And I don't think that was helpful. And I think that's where you saw some of the activity around pensions going on, which probably hasn't led to good investor outcomes around taking the pension tax-free lump sum. But I think, the good news, the good news is that it was short term, and we've seen money coming back in November. Some of that is also, you mentioned the US effect and the impact of the US election. So North America, the North American equity sector was one of our higher selling sectors in November, and I think the kind of the returns that you were seeing on the S&P 500, that kind of market response to Trump, who will pursue a pro-business agenda in the near term has been fairly positive. But I think for a long time, it's also about people seeing the dominance of the US in terms of delivering returns. And certainly even if you're invested in a globally diversified fund, you're probably got a fair exposure to the US market. It's the MSCI World at 70. The US allocation is 70% now. So in the near term, investors thinking, well, we're going to see a boost through Trump. I think longer term, the outlook is still a little bit more uncertain than it was in the middle of last year, because there is this kind of sense that we might see a return of inflation both here and in the US, but for very different reasons. And what that means for rates, it probably means that rates are not going to come down as quickly, or the bank won't cut as fast, or as much, because it needs to be cautious. And that does have an impact in two respects. So one, it has an impact on returns, particularly in equity sectors, for equity growth type stocks. But it's also for investors, many of whom will have kind of mortgage repayments or other repayment commitments. It means that some of the money that might, if you're remortgaging, the prospect of better rates is further away, so that the ability to put more money aside is affected. So I think we'll have to wait and see what next year looks like. There's a little bit more uncertainty than there has been, but there are also some positives, as you say. And what we don't know is, markets have, particularly the US, have done quite well. So I think that, may encourage some more investors to come in, as we saw in November.
Right. Okay. So not a super depressing outlook, but not super optimistic, just middle ground.
I wouldn't say it's not super optimistic. I'd say what it is difficult to call, because it depends on what Trump does on tariffs. Actually, markets don't like the biggest tariffs.
Talking point I've seen.
So, and for example, if you're thinking about emerging markets, so some of the places where, depending on what you want or what you're interested in with your strategy, some of those kind of high risk, high return markets, it's a lot more difficult. I mean, it could be quite negative, some of the stuff that Trump has proposed around tariffs. But it's just not clear whether that's a negotiating tactic, or whether he will go in quickly and go in hard in some of these areas. So I would say, rather than it being not optimistic, it's just a bit more uncertain than it was in the middle of last year. And maybe we will get clarity quite quickly in 2025, and some of this could be quite good for markets. But I think it's just, we're still at that phase where we're waiting to see what happens with some of what's happening with global trade and geopolitics.
So on top of what you've already said, as we are now in 2025, what key trends and developments should financial advisors keep in mind to better serve their clients?
And financial advisors, I think one of the great things that they do is they're not really that interested in short-term development. So I think it is really about that kind of long-term approach to financial planning and setting financial goals. I mean, I guess looking at, and I don't think what we're seeing now would affect a kind of core portfolio strategy, but I do think, it's interesting to think about some of the themes that we're going to see. So I would say the interest rate environment is something that we all keep an eye on if you're interested in investing. Ultimately, even in the US, some of, if Trump is able to deliver what he seeks to do, which is growth, and there's every sign that you're going to see growth in the US economy, that also drives a more inflationary environment. So how is the Fed going to react? And arguably the US is the kind of major market if you're thinking about equity investment. So I think that's something that it will be really interesting to keep an eye on. And what the impact of Trump's policies might mean for different profiles of equity strategies. And I think some of that is more that if you're thinking about your kind of tactical strategies, tactical allocations, rather than your core approach, which I don't necessarily think should change. I mean, the other thing that we're all looking at is what's going on in government bonds, I would say, and the UK gilt market. And I was hearing on the radio this morning, Ray Dalio from Bridgewater, the hedge fund's comments on some of the challenges that we're seeing in the UK for the government with rising gilt yields. Essentially, investors thinking that they want a higher premium for the risk they're going to take in lending to the government. There is a potential for that to get into a bit of a cycle, was his point. And I think, as gilt yields go up, the price of gilt, so the kind of price performance of gilts will fall, but it's also that is going to affect things like the government's position on tax. Whilst they might not want to do any more tax raising, people talk about fiscal headroom, but their ability not to raise tax could be changed by some of the dynamics going on in government debt. And that will impact all of us. So I think these are things to think about. And of course, I guess, from the other perspective is thinking about the kind of changing dynamics for clients in retirement and some of the tax changes in the budget, like removing the kind of IHT exemption on assets and pensions, what's happened in the AIM market. I'm sure advisors are, thinking about those things and what that means for strategies in retirement and how they want to manage that. But I also think we'll start to see some interesting approaches at how the market adjusts and hopefully interesting retirement income products coming into the market as well. So I think those are definitely things to look out for.
Okay. And you touched on it a little bit earlier about how investment attitudes differ between generations. So I wondered if you could go a bit more in depth into that, as well as talk about any proven and effective approaches to engaging different ages in investing.
Yeah. So, I mean, I guess there are two parts to that question. The first is, how do younger investors think about investing? And I would stress that we're talking about people who already invest. So our data, we do some surveys that are just looking at UK adults who may or may not hold investment products. But I think it is really interesting to look at people who invest and how their views differ. And I think one of the most interesting things that we've covered in terms of thinking about different strategies is we've looked at younger investors' attitudes. Well, we've looked at investors' attitudes to investing in the UK in their home kind of market compared with looking at a more globally diversified strategy. And that was partly to do with there being proposals for this idea for a UK ISA.
Yeah.
And I think, whatever you think about investing in the UK and whether that's good or bad, and I know there's been a big push quite rightly to ensure that people are globally diversified. Diversification is really important. I think what we found quite interesting when we did that research was that younger investors tend to be more positive or more confident that investing in the UK is going to deliver long-term outcomes, good long-term outcomes compared with what we were seeing from older generations, particularly the 55 plus. And so that was quite interesting because, of course, one of the big themes over the past few years is how can we reinvigorate the UK capital markets? Some of that's to do with the types of companies that we want to get to list in the UK. Some of that is also to do with how you actually get more that kind of dynamic between privately owned companies and publicly owned companies. But it's interesting to see that there is an interest in UK investing and a confidence in that. And that's something where if we could get it right, it's extremely, I'm not saying I've got any easy answers, but if we could start to see the UK, which is often seen as a bit undervalued at the moment, and actually the FTSE has performed better over the last 2 years. It's interesting that younger investors are looking to their home market. I mean, obviously the other area is sustainability.
Yeah.
We do tend to see when we do investor research that investors are younger investors are pretty keen on sustainable investing in a way that not to say that older generations aren't. So I think the last nearly half of investors that we surveyed that were in the youngest cohort were looking for sustainable funds, and they were much more likely to feel that they would meet their investment goals by investing in sustainable funds. So 23% saying they would, compared with 7% in the over 55. So there are some kind of investment themes or investment areas that younger investors are quite keen on, compared with some of the older age groups.
Yeah. And engaging them, how do you lean into engaging different age groups and different generations? I know that it's probably going to take a lot of marketing. Like you were saying earlier, the amount of capital that you need to get the marketing right to target each different generation, because probably for my generation, you're going to be targeting them via social media, whereas someone who's like Gen X and above, maybe they're still TV adverts or newspapers, something like that is more accurate for them. Maybe even Facebook. I don't know.
Oh God, Facebook is the Gen X equivalent of TikTok.
It kind of is, yeah.
Yeah, I'm not Gen X, I'm a millennial.
Yeah,
so I guess Instagram is my my social media tool of choice. Look, I think we have to explore different ways. I mean, so yes, social media has a part to play, but the thing about social media is that it's also about how that, because there's been a lot in the press about influencers, and some of them are extremely good and help people kind of drive better behaviors. Some of them are not, and it's it is difficult to navigate. And I think so social media has a role to play, but it's also, there are also drawbacks. I mean, the big thing that we believe is going to make a real difference is really pushing financial education and better financial literacy in schools, so that people really start to understand. So, for example, we talked about compounding. What does that mean? How do I think about managing my money, whether that's thinking about the potential impact of credit cards or mortgages, but also if I'm saving, how do I make choices around cash versus investing, and thinking about that, and then the basics of how markets work. What is a stock? What is a bond? Why might you choose it? So I think you can talk about technology, and that's got an absolutely massive role to play. And if we can do better around things like digital disclosure and access and drawing people in, that's great. But it's also incredibly important that they have an ability to understand the basics of managing money and finances. So I think there is a kind of real need. I mean, on the positive side, what we do see when we do some of this investor research is that this generation, the youngest generation, is one of the best educated generations we've ever seen. They're much more likely to have university degrees, and they are more likely to have had some kind of financial education in school. So it if we can really build on that momentum, I think that's important. And I would really like to highlight. So we did a story on New Year's resolutions actually at the end of last year, and I think a lot of people feel like young people, right? People of any age are just like, oh God, finances. I don't want to think about it. It's I'm not interested.
Yeah.
But when we did that research, we found that about just over 2/5 of the UK adults were planning to set financial goals in 2025. So they did care. So that was second only to health and fitness resolutions, above travel, above romance. Wow. I don't know what that says about us as a nation, but frankly, setting financial goals was the second most popular option. And I think, and that was across men and women, so it's equally important to men and women. And when we looked at the youngest age group, they were actually 3 times more likely to make a financial resolution than those over 55. So 64%. So they have decided to prioritise their financial goals. And once you ask them about it, and I think this was the thing that really interested me. So some of that was people wanting to save more. Yeah. But for the people who wanted to invest more, particularly when they said they wanted to invest regularly, we asked them, okay, so how much would you want to commit each month then? We gave them a range. And I think I was expecting people to say something like £50, but in fact, the average was between £200 and £500 a month. So these are serious numbers.
They want to meet their goals quickly.
Yeah, exactly. I mean, and I think that kind of says that we need to think again about people's attitudes to financial goals, because ultimately financial goals are about building a better life. Yeah. And people do care. So yeah. So I would say it is about kind of technology. It is about ease of access, and social media can help, but it is also about financial education as well. And the interest is there, importantly, from what we saw in our New Year's resolution story.
And finally, if you could offer one key takeaway or piece of advice to UK financial advisors for 2025, what would it be?
One piece of advice for UK financial advisors for 2025. I would say, I think some advisors do this, but I think it is about that intergenerational wealth planning piece. Yeah. It's about thinking about the fact that, how do we kind of help different generations of the people that you advise, and particularly because I think some of the changes around inheritance tax are going to start people thinking about, okay, do I actually want to kind of pass that money on now, and how can we do more? And I know a lot of advisors look at this all the time, but I think that's going to be really key in 2025, and a key area to think about, because we're going to see changing behaviour, and then there is momentum anyway, I think, behind that.
Yeah. No, I think it's going to be a very interesting year, and I'm excited to see what unfolds. But thank you for speaking with me today, Miranda. This was a really interesting conversation.
Pleasure.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.